Hi, everyone. Welcome to our webinar on Uncovering the Hidden Risks, a Mortgagee's Guide to Compliance. Before we dive into today's topic, I'm going to run you through some items to help you best leverage our platform. Your webinar dashboard is interactive and customizable. You can personalize your view by moving, resizing, or hiding different elements on the screen. Simply use the corners of the icon to adjust the size or position of each box. We encourage you to engage with us using the interactive tools. If you have any questions throughout, please submit them using the questions box on the lower left corner of your dashboard. We will do our best to address your questions in real time, but we will also answer them at the end if we don't get to them right now. You will also notice a survey on your dashboard. Please fill this out anytime during the presentation. To let us know your thoughts throughout the presentation, use the emojis at the bottom of your screen. Your feedback is very valuable to us, and we do use it to craft future webinars. For those of you seeking CPE credit, you will need to answer 3 of 4 poll questions during the webinar. CPE certificates will be sent out via email within a couple of weeks. And yes, this session is being recorded. You will receive a link to the recording within a couple of days. If you would like a copy of the slide deck, you can download it at any point during the presentation from the left side of your screen. You will find links to many other resources in that same box on the left side there. Now that we've covered all of the details, I'm going to turn it over to Rosie to introduce today's agenda and our speakers.
Hi, thank you, Gabby, and thank you everybody for attending today's session. My name is Rosie Marlier, and I'm an assurance partner here at Ritchie May. I've been with Ritchie May since January of 2015. And I am in the mortgage banking department where I complete financial statement audits for our clients, as well as oversee the compliance department.
Fantastic, and good to meet all of you guys. My name is Connor Gaffney. I'm a senior associate within the mortgage banking audit department, and I've been working with Ritchie May for about 3 years after having left a previous role as a loan originator. So I'm going to walk you through kind of the agenda of what we're going to be discussing today. We're going to go over some of the common findings. That first bullet that you see there is Ritchie May. These are insights that we received during the audit season. So over the past year, when we've been working with any of our clients to identify any of the areas of instances of non-compliance or just general areas in which we can provide an opportunity for a recommendation to improve. We also have noticed anything that's come through the Housing and Urban Development, or HUD, as we'll refer to them for the rest of this session. We also received some of the findings from Ginnie Mae, and we'll discuss those as well. I'll then turn it back over to Rosie at that point, and she'll go over the Ginnie Mae all-purpose memorandums. We'll also discuss some of the HUD mortgagee letters, and then from there we'll go into a question and answer where we can answer anything that you guys are asking. First, though, we get to start with the fun of a CPE question, a continuing education question. So you'll see there in front of you, should be popping up right about now, saying, what area would your team benefit the most from learning about? So we have a few different options for you. So go ahead and make sure if you want that continuing education credit that you answer one of those 4. Would you like to learn more about the quality control plan language, quality control review documentation, servicing requirements, or even those reporting requirements, including upfront mortgage insurance premiums, sale and servicing changes, etc. So we'll give you a little bit of time to go ahead and answer that first continuing education credit question. Feel free as you go through our presentation today, if you do have any questions, feel free to utilize that chat function. We'll be keeping an eye on it and trying to address all of those towards the end. All right, we're seeing that a lot of the responses are starting to come through. Give it maybe another 5 to 10 seconds. Make sure you're able to get those answers in. All right, looks like we've got a good majority, so I will kind of continue along at this point. The first thing that we're going to talk about are the insights from our audit season. So what we, Richie May, do in order to make sure that everyone is in compliance with the regulations, with the guides. The big one continues to be anything related to the quality control plans themselves, both either the physical writing of the quality control plans or the quality control review program that you institute within your own business itself. Some of the items that we noticed that were kind of seen around a lot of our clients this year, and I wouldn't say a lot, but they were definitely apparent, is going to be again about that quality control plan. The first is making sure that anyone that is involved in the day-to-day operations within the quality control department is independent from any of the loan administration or loan operations functions within your institution. So making sure that there is no undue influence, or there's no opportunity for someone that's on the servicing team, someone that's on the origination team to be able to come through and say, hey, go ahead and let this loan slide. You want to make sure that the quality control function is completely separate from any of the other loan administration or underwriting or origination functions themselves. The next is going to be the semi-annual review of affiliates. If you utilize any third parties in order to originate or underwrite or service your loans, you want to make sure that at least twice a year you are checking the SAM and the LDP, which we'll get to in a little bit, making sure that they are meeting the requirements and making sure that they're that they are registered correctly. The next is self-reporting fraud, material misrepresentations, and findings. We've noticed that through the Office of the Inspector General, they've started looking at this from a HUD perspective a lot more. If you were to go to their website, you will see that there have been a number of incidents where clients or mortgage companies are underrepresenting and underreporting any of their fraud, material misrepresentations, and findings. And that's causing HUD to look a little bit closer at those individual companies. So making sure that if you do uncover any of those items, that you're reporting them correctly. The next is multiple policies and procedures. The HUD handbook requires that every mortgage company has a quality control plan in which you're going to oversee the operations of the company itself. But a lot of times, if you are contracting out to third parties, we've noticed that there are people that are relying, or companies that are relying on the third parties in order to do the job functions. The way that HUD essentially has put together their requirements or their restrictions is to say that you, as the mortgagee, it is ultimately your responsibility in order to make sure that the operations that are happening for your loans are yours, and the buck stops with you. So making sure that if you do utilize third parties for whether it's the quality control reviews or sub-servicing components or anything else, that you are still ensuring that they are following the rules and making sure that anything that is inside of their that is required for you with the quality control plans, making sure that you are responsible and know that the buck again stops with you. The next is going to be pre-fund and post-closing required elements. So we have noticed that there are some times where if you're doing a post-close quality control review, that you are not obtaining a new credit report, or that the credit report is not being obtained in the same manner that it was originally. So if you've got a tri-merge credit report as required at the time of the origination, that if you were doing this as a post-close quality control review, that you were also getting another tri-merge credit report in the exact same manner or fashion that you did for the underwriting component. And the last is going to be that re-verification of specific items. The HUD handbook definitely lays out that there are certain items that you have to re-verify in writing, and if writing is unavailable, to do it electronically, including employment, income, assets, and source of funds. So making sure that as you go through those review processes, you are doing what HUD is requiring. Again, on the same breath, is still those quality control reviews. We have noticed that once you get from the QC plan into the quality control reviews, whether that's pre-fund or post-close, that there have been some issues where HECMs, for example, if you were to originate them, that are being left out of that sample population. HUD requires that you look at the entirety of your lending and origination portfolio. So anything that if you do originate any of those home equity conversion mortgages, that they're being included inside of your population when you're making those monthly samples. And the next is going to be timeliness of reviews and reporting to management. There are 3 different components on when these quality control reviews, especially post-close, need to be done. From a post-close perspective, you have to do an initial review. You then have 30 days from when that initial review is done in which those findings have to be reported to senior management. Senior management then needs the opportunity to respond back to any of the issues that they saw, whether that's from an underwriting perspective, from a loan administration perspective, from a processing perspective. They then, after, are able to respond to any of the initial findings. They need to be dealt with in a timely manner and then ultimately put into a final quality control report. So I know it's a little bit of a process. There's multiple parties that are involved, but making sure that you are going through those 3 steps: the initial review, when it was submitted to senior management's responses, which we'll talk about here again in a few minutes, and then also making sure that you have that final quality control review report that is done in a timely manner. The next is going to be incomplete early payment defaults. The HUD handbook requires that you are looking at your early payment defaults within a time. Don't specifically decide or define when you need to do that, but you are supposed to be checking them on a monthly basis. There have been some of the reports that have gone through that OIG, that Office of the Inspector General, in which the EPD reviews that were being done by certain companies were not up to the requirement. Essentially, if you're doing an EPD, if you have one of those types of loans, you want to make sure that you're doing a full quality control review of the loan, from the origination, the processing, the re-verification, to make sure that you're hitting all of HUD's requirements themselves. Next is going to be that insufficient sample size. So as I had mentioned just a little bit ago about including those HECMs, making sure that you understand when was a loan originated versus when was it funded, and making sure that the population size before you go and make your selections is correct. As required by the HUD handbook, you have to do 10% of the originated loans from a HUD perspective. You have to do those quality control reviews on a post-close basis. So making sure that your sample size is correct. We would never get mad at you for doing more. So, more is probably always better. Last is going to be the stratification of the mortgage product. Some of the situations that we've come across over the last year where people were taking their entire production list. So that's going to include HUD loans, Fannie, Freddie, portfolio loans, adjustable rate mortgages, where they were saying essentially, hey, we have 10,000 loans that we originated in this last month, which is a great month. But making sure that when you're making that 10% sample, that you're not utilizing the entire population. You do want to stratify it. So that way, if HUD loans are 50% of your population, you're making sure that you're just selecting 10% of those HUD loans, of those Fannie, of those Freddie. So rather than just using the population in its entirety, you want to get to the specific on the type of origination that you did. Again, remembering that your HECM loans still need to be included in that population of your forward-facing HUD or FHA mortgages. Next, we get into the denied quality control reviews. Kind of a weird topic here because HUD doesn't specifically say how much or how often you need to sample your loans. But what they essentially have said inside the HUD handbook is you should be reviewing the denied loans to make sure that they were done correctly, whether that's from obtaining the necessary documentation to make sure that the loan truly wasn't going to be able to be originated, or whether it was making sure that the processing or the administration or the reports were actually given out to that denied borrower in a timely manner. We've noticed that denied QC reviews probably haven't been happening for some of the companies that we audited this year. So making sure that you are maintaining some sort of a policy and procedure to review any of those denied FHA loans, or you complete them late. There is a requirement that you have to make a sample selection and do a full review of those denied loans within 90 days of the month end that the loan is denied. And again, that is 90 days. That is not 3 months. So as those months kind of change, where you have February only having 28 days, you want to make sure that you are tracking to figure out when that 90-day period from the month that the loan was denied to make sure that you're reviewing it correctly. The next is not following your QC plan. Again, HUD does not design or require how you do your denied QC reviews or at what percentage those denied QC reviews have to happen. We at Richie May recommend that you do a 10% sample of your denied loans in order to kind of follow what we are expected to do with the post-close QC reviews themselves. But there's also the aspect of what do you have written into your quality control plan? You want to make sure that you are following that, because once that methodology is documented, you need to be acting in accordance with it. Some more insights from the audit season is around the loan origination and the settlement aspect of the business. So the first is making sure that your IRLA, your 1003, that Uniform Residential Loan Application, is agreeing to the other supporting documentation that we have. You know that it's a little bit difficult at times to be able to prove exactly how you underwrote the income for a particular borrower, how you were able to classify what assets were admissible and which ones weren't. But you want to make sure that those forms, those final forms, are all matching. So the Uniform Residential Loan Application, if you're saying that a person originates or makes $1,000 every single month, $10,000 every single month, that same income is being reflected on the supporting documentation, like that 92,900 loan transmittal. The other one that we've seen is an over escrowing of insurance and taxes. So keep in mind that when you do a forward mortgage, especially on a purchase, you're going to be collecting that first year's worth of the insurance premium, but you're also going to be doing an escrow, making sure that the calculations are correct. If it is a $1,200 insurance policy, then you should be escrowing that 3 months of $100 to make sure that you have that available as part of what HUD is required. But making sure that you're using the same calculations and not over escrowing or not overly collecting on the tax basis. It can be a little bit difficult when you do have a new build residence where the taxes can be, moving around, but making sure that you're not overly burdening the individual borrower by collecting too much from them just to have a slush fund. The last is going to be that late remittal of the upfront mortgage insurance premiums. So on a forward mortgage, you have 10 calendar days in which those funds have to be remitted to HUD, making sure that you have someone or multiple people on your team that are able to send those funds to HUD within an appropriate period of time. If you have a home equity conversion mortgage, you have a 15-day, but remember it's calendar days. HUD likes to go back and forth within the documentation in the handbook as to what is a calendar day versus what's a business day and what the different requirements are. So making sure that you understand that on the upfront mortgage insurance premiums, those are going to be based off of calendar days and not business days themselves. A new one that we started looking at a little bit closer this year was the mortgage change records. So there's two parts to that. Anytime that you originate a loan that you are ultimately selling to any of the investors, you have a 15 calendar day period in which you need to notify HUD that you have sold the loan. And if you've sold the servicing, who did it go to? But that also extends to the fact if you're doing an MSR sale. So if you have those mortgage servicing rights of a large portfolio and you are transferring them to someone else, you have that 15 calendar day window from the date that that loan is being transferred in order to do the reporting. So you want to make sure that you are A, hitting that timeliness, but then B, you also want to make sure that you're maintaining that documentation itself. When you submit the change notification through the portal, it does not do a snapshot of those individual loans. So if HUD was to come back to you and say, prove to us that you notified us on Monday that you sold this loan, unless you're doing an individual screenshot or printing something that you are then saving with your loan and with your records, you're unable to prove to HUD that you did notify them at the actual time. The way that the FHAC system works is going to be the notification at most recent. So if a loan was sold from you and then the servicing changed again and again, it's only going to show the most recent change. It will not show when you had submitted that notification to them. The next thing is going to be relating to the servicing aspect as well. If you are servicing loans, you want to make sure that you are following some of these things that you see there on the screen. The first is late escrow refunds. So if a loan is completely paid in full, whether that's someone got a new refinance or they hit the jackpot and they were able to pay off their loan, which we love that for them, you have to make sure that any of the escrowed funds that you have, you are remitting back to them within that 30 days. So making sure that you are keeping on top of that. The next is the adjustable rate mortgages. You have to follow what the note says. If it's a 5-1 ARM or a 7-1 ARM, and you say that after the 5th year or the 7th year, that we have the ability to adjust the interest rate up or down, making sure that you truly are following the terms of that note, whether you originated it or whether you bought it from someone and you are now actively servicing it. So making sure that you understand what the requirements are with the loan and when is that loan supposed to adjust. We did notice a few times where the loans were automatically being adjusted the first month of the year, so January, regardless of what the terms of the note said. So maybe a loan was supposed to have adjusted in July, but it was held on until January in order to make that adjustment. So making sure that you're following the terms of the notes, that you are agreeing and managing the loan in such a way that the borrower is in agreement with. The next is the annual escrow not being performed. Kind of a requirement. So every year for any of loans that you are servicing, you want to make sure that you're doing annual reviews of it, making sure that if it is an adjustable rate mortgage, are you disclosing to the borrower that that loan interest rate is going to change? If you received updated insurance information that their policy premium is increasing by $100, that you were disclosing to that individual borrower that you were going to be increasing their escrow on a monthly basis. Or if the taxes have changed, it went from a new build property to now it's an existing residence, and so the individual city decided to up the taxes. You want to make sure that you are communicating that. The only way to do that is by doing an annual review of the loan themselves. There's different ways to do it. You could do it at the first of the year. You can do it on a rotating basis based off of when the loan was originated, but just making sure that you are touching all of those loans on an annual basis. And the last one is the escrow interest not being credited to borrowers. If you are in certain states, not every state, but states like California or Iowa, for example, you have to make sure that if the funds that are being held in escrow are in an interest earning account within the bank, those funds do have to be deposited back to the individual borrowers. So take a look to see where you are servicing the loans in any particular state and check to see if that account that you have is an interest bearing account. There's also different requirements and restrictions based off of when you need to release those funds back to them. Some states are quarterly, some are annually, and some are just drop dead December 31st. So getting a better sense and understanding of them. Some of the HUD findings that we've seen, so this is where HUD's coming through and doing either servicing reviews or just field reviews of clients that we have worked with over the past year. Deficient QC plans. I know I hit that pretty hard earlier, that saying you want to make sure that all of that is going to be documented, that you know what you are doing and be able to prove in writing to HUD what you were doing as far as your quality control plan. The next is the insufficient scope and depth of those EPD reviews. Slightly mentioned it earlier too, but if you do have those early payment defaults, as we've seen the defaults are starting to kind of pick up within the industry itself, making sure that you're doing a full review and not just doing the bare minimum, not doing a limited scope review of those loans that are popping up. The next is incomplete self-reporting of unmitigated findings. If you go to the notification page for the Office of the Inspector General, you'll see that there have been a lot of mortgage companies that they are focusing on over the past year that are saying that, hey, if you're not reporting to us any of your fraud or material misrepresentations or whatnot, or you did have a finding, but you didn't fully mitigate it, but it didn't meet the level of fraud, you still have to report those items over to HUD so that they're able to track it. So making sure that you self-report, it's been very important over the last year or so from HUD. The next is that affiliate confirmation of system for award management, so SAM, the limited denial of participation, and the nationwide mortgage licensing system and registry. So making sure that any of your individual employees or any of the affiliates that you utilize, that you are reporting and checking those at least semi-annually. Next is the direct endorsement underwriter registration, making sure that the employees that you actively have are the ones that are being reflected on the website itself. And so, as you hire new individuals and as you lose other individuals because they've gone elsewhere, making sure that you're maintaining that list. Last is going to be, not last, but the late QC reviews. The HUD handbook specifically ties out exactly when those quality control reviews need to happen, both from a pre-fund, a post-close, and an EPD perspective. So making sure that you're following there. Inadequate senior management QC review responses. So while it's important to do the initial review, you also want to make sure that when senior management is involved, that all of the what they are doing is being documented correctly. It can't just be a phone call. It needs to be written down. Hey, we talked with so-and-so, we did this, or we collected additional documentation. The last on this slide is going to be the case binders missing the documentation themselves. So making sure that anything that you do, you have physical proof that you did it. Whether that's you notifying HUD that you had sold this loan to a different company, or whether it's I received an updated verification of employment, making sure that all of the documentation is held within the case binder of itself. Few Ginnie Mae findings to go through just real fast. First, make sure that if you are Ginnie Mae approved and you have your bank signature cards, that the tax identification number of the company is included on them. It needs to make sure that it matches entirely. And then loans liquidated without the HUD 11708. So if you have a loan that is being paid off or removed from one of your pools for whatever reason, you want to make sure that that HUD 11708 is completed. All right, we are going to go ahead and move into another one of the continuing education credit questions. So if you are wanting CE credit, make sure that you are answering this question. So we're looking to see how confident do you feel in explaining the definition of affiliate from either a HUD or a Ginnie Mae interpretation. So can you provide that training to others? You have affiliates but don't know necessarily who meets the definition, never heard the term affiliate before, or you actively know that you don't have affiliates and so it doesn't matter. You don't need to keep them defined. Awesome. And I'm seeing responses come through. And I'm going to be turning my mic over to Rosie here in just a minute once we get a few more responses. But she's going to go through some of those all-purpose memorandums and some of the HUD mortgagee letters that I alluded to earlier. So give it a few more seconds. And there we go. I think, Rosie, if you're ready, it's all yours.
All right. Thank you, Connor. Really great information. I'm going to go ahead and jump into some of the Ginnie Mae APMs that were released. We did this webinar last year in November of 2024. So I went ahead and just added the APMs that were released since our last one. If anybody has, or if anybody wants information from the webinar last year, it was definitely more Ginnie Mae forward. They had all the changes to those capital requirements and whatnot. So we can get you any of that information. But as far as what was released after that, just a few of them. The first two that were released are related to high balance loans. It focuses on details related to eligibility, documentation, and reporting requirements, as well as proper management related to these high balance loans. And they also offered issuers a 60-day extension to submit their Fidelity and E&O insurance policies. In 2025, they only rolled out 5 new ones. Number 1 offers some guidelines for ensuring a smooth transition and maintaining compliance during a migration process in case you switch custodians. Number 2 and 3, both of these are related to different eligibility requirements related to buy downs, as well as guidelines on managing specific types of loans. And they also updated the HUD 11708. They added reason code 7, which applies to special assistance. So any loans that were liquidated via special assistance programs, they could be identified and issuers can now go and get those loan documents from their custodians. Finally, number 5, they already had this in place for any lost, stolen, destroyed, or missing mortgage notes for modified loans, but they now can actually use them for reperforming loans as well. Next, jumping into the HUD mortgagee letters. Again, since our last webinar, not a ton came out in 2024. They rolled out the new maximum claim amounts and loan limits for HECM loans. They also gave some modern strategies and tools to enhance communication and support for borrowers that are in default and loss litigation. And finally, they gave an extension of the foreclosure moratorium for anything that was in connection with Hurricanes Helene and Milton. 2025, new administration, a little bit different. There are 19 total mortgagee letters that have rolled out this year. Instead of going in order like I did the other ones, I'm going to touch upon some common themes that we've seen instead. The first one being rescissions. So there are a couple listed on here that aim to streamline the streamline and simplify the appraisal process. They tried to remove any sort of outdated or redundant or costly protocols related to those appraisal processes. And then they also rescinded requirements related to the supplemental consumer information form, full-time direct endorsement underwriter requirements, the federal flood risk management standard, and any mandatory pre-endorsement inspection requirements for any properties located in presidentially declared major disaster areas. So if any of that is impacting your operations, you might want to go and see if they removed some of those requirements for you guys. Next, more extensions of foreclosure moratoriums. They offered the second extension for anything related to Hurricane Helene and Milton. They also have some extensions of foreclosure moratoriums. So they offered a second extension related to the Hurricanes Helene and Milton that they had rolled out in 2024. And then they also offered an extension for all of the properties related to the Los Angeles County fires this year. Next, we have some updates on servicing and loss mitigation. Number one, they included new categories and definitions. They're aiming to improve the accuracy and consistency of servicing loan reviews. There is an appendix available that updates the language related specifically to severity tiers, remedies, and indemnification. Number six, they actually made quite a few changes to sections 3 and 4 in the HUD Handbook 4000.1. So I strongly recommend going to this mortgagee letter, looking through any highlighted areas that are going to be added or amended, and also areas that they might have struck out. Number 12 is actually just a replacement to part of the announcements in section 6. They are specifically related to the permanent loss mitigation option. And finally, number 14, they're continuing to modernize those requirements. These updates are specifically related to the interviews with borrowers in default and for loss mitigation. Next, we have just general revisions, changes, updates to already existing things that they had. They made some changes to the DSCR, LTV, and LTC ratios. If you go to this HUD mortgagee letter, they have a table where you can reference all of those percentages. Number 4, they implemented some flexibilities related to the documentation and calculation of income from borders of the subject property beyond the current standard. And then number 5, any nonprofits that are looking to participate in single-family nonprofit programs, you want to check this area for any changes to the application and recertification requirements for nonprofits. Number 9, they had some updates to the borrower's residency requirements in order to be eligible for FHA financing. They specifically added language around Micronesia, Marshall Islands, and Palau. They announced the annual revisions to the high cost percentage and high cost areas. Again, if you go to this letter, there's going to be a table with all of those updated percentages for you to reference. And then finally, they changed the post-foreclosure sales period to 60 days. And they also changed the exclusive listing period for HUD REO to 15 days. And last but not least, kind of in a category of its own, there is a proposal to create a new set of underwriting thresholds for middle income housing through the multifamily program. So if you have some multifamily business, please go ahead and check out that new proposal. We're going to jump now into our third CPE polling question. Do you know where to access updates and new guidance from HUD, Ginnie Mae, and other regulatory bodies? If you know where to access all of the updates, select A. B is I know how to access one of them. C, I wait to receive email updates. Or D, I'm not aware that this information is posted publicly. We're going to go ahead and give you guys a minute or so to get all these poll questions in. See some answers trickling in. Looks like we're still waiting for some people, so go ahead and continue to take some time. All right, looks like we're getting pretty close. I'm going to give you about 10 more seconds to get those in. Great, great. Well, in case you don't know where to find some of these, we went ahead and added a table for everybody. The new administration made a lot of updates to the online websites. So where you might have been used to getting the information previously, it might have moved around a little bit or look a little bit different. So for HUD, if you want to see those mortgagee letters, and if you're an FHA approved lender or a servicer, they are going to communicate any new policies or clarify existing guidance, announce any changes to those FHA programs. If you go to HUD.gov and then look at and then click HUD Partners, you are able to then access HUD Clips. And then there's a button for letters, including the mortgagee letters. For Ginnie Mae, those APMs that we discussed, if you are an issuer, custodian, investor, and you want to see any program requirement changes, any operational updates or pooling or issuance guidance, if you go to ginniemay.gov and then click on issuers, you can then go to the program guidelines and they're going to have a button there for those APMs. We didn't touch on Fannie Mae and Freddie Mac, but a lot of you are approved seller and servicers with them. So if you want to see some Fannie Mae letters for any urgent or temporary updates, such as disaster relief or forbearance programs, if you go to the Fannie Mae website, I put on here single family business and the selling guide, but obviously if you're doing other programs with them or you want to access the servicing guide, that'll change up a little bit. But once you get to the selling guide, you can then see guide resources, and it's going to direct you to those letters where you can see those updates. Finally, Freddie Mac, if you want to see any policy, process, or operational updates for selling and servicing, you can go to their website and they have a button that says View All Bulletins. That's going to get you to all of the bulletins that they have updated. This is probably great to look at now. I know Fannie Mae is making some updates to QC requirements, so you might want to familiarize yourself with that. And they also have some new things that they rolled out related to cybersecurity and those types of requirements. So definitely worth checking out to see if you can get those updates. On all of these, you are also able to access specifically to sign up for like email updates and everything. So you can kind of get your information that way as well. All right, and with that, we have our fourth and final poll question in case you happen to miss one of the first three and you still want your CPE credit. But do you believe any of the Ginnie Mae APMs, HUD mortgagee letters, or instances of non-compliance discussed today will have an impact on your current operation? A, yes, B, possibly, or C, no. We'll give you guys about a minute to get all your responses in. I should also mention that there's an attendee chat. If you guys want to throw in any APMs or mortgagee letters that you think are going to have an impact on your operations, it might be great to see what your peers are saying. Make sure nothing slips through the cracks and get a little conversation going. So feel free to throw something in there if you feel like it as well. I'm going to take about 20, 30 more seconds for these lingering answers to come on through. Like we almost have everybody. Get those final answers in. All right, we're going to go ahead and close that final poll question. I'm going to kick it back to Connor for some key takeaway notes that I think might add some context to really highlight everything, and then we will jump into Q&A. Thank you.
Perfect. Rosie, thank you. I don't know a lot about the Ginnie Mae APMs, so I appreciated hearing from you there. One thing I did kind of want to reiterate was related to the quality control plans, the quality control review program, everything like that. I know I harped on it quite a bit at the beginning of our training here today, but we've noticed that HUD is doing a lot more focus on making sure that you have the documented policies and procedures. It's amazing to do what you do and making sure that you've got the best people that are able to do the job on a daily basis, whether that's the review aspect, the servicing, the loan origination, everything like that that is part of the business that y'all do on a daily basis. But HUD has been really cracking down on prove it. They kind of feel like the state of Missouri at this point, right? The show me state. So making sure that if you are putting those policies and procedures together, anything that you do on a daily basis, that you are making sure that it is documented, because when HUD has been coming through, from what we've seen at least over the last year, is they're asking questions that should be answered already. So expanding your QC plan themselves, expanding the documentation around your quality control review processes in order to make sure that you are able to say to them, we do these things, here's what we do, and here's exactly why we do them. And I think that bled a little bit, Rosie, to what you were talking about with some of the Ginnie Mae APMs and some of the HUD mortgagee letters as well, is, you know, if someone is asking you those questions, it's because you haven't documented those policies and procedures correctly. So we can't stress enough that you should very much focus on documenting and writing every single aspect down themselves. The other part that I think I wanted to mention was I talked about the HUD handbook quite a bit, but if you were to ever review the HUD audit guide, that 2000.04, there's a lot of good information there that'll help you, dial up your business, get a little bit more specific on what you're doing on the daily operations, or on making sure that you are self-checking what your servicing, your origination, your loans all look like. The HUD audit guide, that 2000.04, chapter 7, is where the HUD FHA approved mortgagees, basically that's what we look at. So kind of going through yourselves independently, that HUD 2000.04, that audit guide, chapter 7, will help you scale up your operations to make sure that you're more operationally efficient.
Yeah, Connor, that's a really great point, bringing up the HUD audit guide. Unlike other audits where you don't know the procedures, and that's the purpose, is that you might not know the audit procedures. HUD compliance and Ginnie Mae compliance for chapters 6 and 7 give you all of the steps. So if you want a sneak peek into what your audit is going to look like this fall, if you happen to work with us, you can go ahead and do that. I think, key takeaway from this section is basically being aware of what HUD and Ginnie Mae are requiring, knowing exactly what we're going to be looking at, getting your P&Ps in order, and then obviously making sure that you're staying on top of everything through the guidance that we were talking about, getting those updates, making sure that you have those email notifications coming through, the mortgagee letters, any sort of APMs, and then making sure that your team is able to update those before the auditors come in. It's going to save everybody a headache on the back end. You're going to have a seamless audit season this fall going into winter for field work. No surprises or anything there. So appreciate all the information, Connor, and hopefully everybody feels confident with their compliance team. We can go ahead and move into our Q&A section now. Right. We have gotten some good questions from the audience already. I will read the first one. It says, you mentioned updates required by Fannie Mae. Can you please elaborate? I could take this one, Connor. I was mentioning that Fannie Mae rolled out some updates to their QC requirements. There's some language specific to third-party originators that you might want to take a look at if you're working with those affiliates. There is also some language related to the sample sizes. I think they are making it look a lot more similar to HUD with the 10% types of requirements. There is a letter that they announced that also came with an appendix. So I highly recommend going to that appendix, and it summarizes all of the changes there specifically related to the QC plan. Another change that Fannie Mae has rolled out recently is specific to a supplement on information security. Shameless plug for Richie May. We did release some blogs recently that are related to cybersecurity, things that we can kind of help out with our clients. Specifically, they are requiring an annual network penetration test. So that's a new change that you would need done by an independent party. I think Gabby or someone, we can drop something into the chat, maybe a link to those blogs and a link to the appendix so you guys can access those quickly. Another question we have, what is your recommendation on how to improve our QC review process? I will kick that one over to Connor, who has been talking a lot about this. So Connor, you want to field that one for us?
I certainly can. Thanks, Rosie. How to improve the QC review process? There's a lot of aspects to that, for sure. You know, if you were to go back to that website that I mentioned just a bit ago about that OIG, HUD has seemed that they're starting to look at the quality control, again, plans and the reviews themselves. As I mentioned earlier, I think more is better. HUD lines out that you need to review 10% of your FHA loans on a monthly basis as part of that post-close review process. They don't say that you can't do 20 or 30. And some of the write-ups or some of the letters that have come out from the OIG are specific to not ensuring that your population or your sample is a sufficient size. So, you know, being able to make sure that at bare minimum, you need to do 10% of the FHA loans that you had originated in the previous month. That goes back to making sure that, you know, if you do originate those HECMs, that they're being included inside of that sample size. Another thing that we've noticed is some of our companies don't have a very good process for those discretionary reviews. So we know post-close is just it's a flat 10% sample, but ensuring that if you have new underwriters or if you have certain branches that the production's been kind of funky, or if you've got new markets that you've entered into, that there is something that's written into the quality control plan and then as part of the quality control review process to ensure that you have an ability to make discretionary samples on a monthly, a quarterly, or an annual basis, basically expanding the scope of just, instead of saying, hey, we're throwing at a dartboard and we're grabbing these individual loans because they hit that 10% requirement, being able to truly show that, hey, we are identifying, you know, these areas that we need to improve in, or these deficiencies within kind of our originations, and making sure that you're reviewing those loans or those underwriters or those processors. I think the other thing too from the post-close reviews has been that you're only looking at like the income and the asset documentation or the re-verification around those items. But what HUD truly looks at is making sure that on your quality control reviews, especially post-close, that you're looking at the entirety of the loan itself. So, you know, income and asset documentation is fantastic, but you want to make sure that the loan administration functions are going correctly as well. So whether that is getting a field review of your appraisal, or whether that is ensuring that the communication was secure, making sure that you're not just looking at the basic items, but the whole process of the loan. And then that last that I kind of mentioned earlier too, that HUD has been looking for is making sure that you're self-reporting. So if you do have loans that have issues with them after you've originated, you're going through this post-close review, or you're going through that early payment default, that APD review, making sure that if you are finding that there's issues, that you're reporting them to HUD. It never feels good having to admit, mistakes or if there's some issues, but under-reporting is not kind of the thing you should be doing. You should overly report and kind of tattle on yourself a little bit, if that makes sense.
Thank you. I actually have another question I'm going to send your way, Connor. Somebody asked if you can elaborate on the defaults that you or your clients have been experiencing.
Yeah, so defaults have been on the rise. Hopefully our clients or anyone who's listening on here right now has not been experiencing this. But Fannie Mae came out with a report about a month or so ago, maybe 2 months, that they were saying an increase in defaults or issues with their refinance loans. It might be an issue that had come through from the pandemic, where there were so many loans that were being refinanced at a time that we weren't able to do the full reconciliation or the correct recording of that information for those individual borrowers. But there's been a very large spike, I would say, in the default and claims rate that we have noticed. So whether that's looking at HUD loans, those Fannies, those Freddies, I think there's two parts to that question, Rosie. The first is, again, documentation, making sure that within the quality control plan that you have, or that our clients have, or that a mortgage company has, making sure that you've written those policies and procedures on how are you monitoring that information? How are you ensuring that if loans are going bad, that you're capturing that information and you're being able to respond to it appropriately? I think the second is making sure that you have an advanced policies and procedures around those loans as they start to go bad. I had mentioned earlier those early payment defaults. Sure, that's just an instance where HUD is saying, hey, this loan went default within the first 6 months, but making sure that you have a way to be able to monitor that information and have, again, as bad as it sounds, those documented policies and procedures, making sure that it's like, hey, once a month, we are going to pull a list of all of the loans that we've originated, and we're going to review them for these aspects. Or once a quarter, we are going to do an entire review of our portfolio. As I had mentioned, HUD is cracking down on making sure that you have all of these items documented, those policies, those procedures. But that's not good enough. You need to make sure that you're following through with it and ensuring that the people who are going to be doing those reviews are well trained and are able to identify those issues. Again, I think that links back to what you had, or what I was talking about here a few minutes ago, which was, if you do notice those issues, make sure to report them. Don't hold on to them, because that's where you get in trouble.
Looks like we still have a little more time. So another question submitted was, have there been any updates to the Ginnie Mae standards that were released last year? I can take this one. No, nothing has been released since Ginnie Mae APM 2412, where they started talking about the hedging efficacy. So the capital ratios that were updated last year should be still the current requirements. Same with the Ginnie Mae net worth and liquidity and insurance requirements. No major changes that we're aware of or on the horizon. We did hear from some clients, some issues maybe when they were submitting the Ginnie Mae schedules for their net worth, where the numbers didn't work out. I think it was because Ginnie Mae is accessing maybe real-time commitment authority type of stuff. But other than that, besides just those website kinks, there hasn't been anything that we would need to report to you guys that you'd want to implement for this year. And that is all I am currently seeing submitted. If anybody else has any questions that we weren't able to get to, please feel free to submit them. We'll make sure that we reach out to you individually via email. We appreciate everybody's time and participation, and we hope to hear from you all soon. Thank you.
Everyone.